Let's take a look. Let's have a review of what we saw last week. Inflation numbers coming through on long-dated bonds. How are we starting to see those yields responding to those inflation figures? And of course, we are anticipating the MPC rate decision as well.
Yeah, hi. Thank you for having me once again. Just a quick wrap of what we saw last week. We saw a bit of cautious trading on the market in view of the inflation numbers that came through. And of course, we must highlight that the bond auction that happened last week really influenced the market significantly. The two securities were reopened, the 5-year bond and the 10-year bond. And of course, investors showed more preference for the 10-year bond, given the 196% oversubscription in that bond, which also highlights the fact that we continue to see a lot of foreign interest in the domestic market, portfolio interest, of course, rather than the much required foreign direct investment. Yeah. So much towards the end of the week also, following the meeting of the FA Federal Budget Allocation Committee, we saw increased cautious trading. And of course, today, by the close of trading today, we've seen yields drop a bit and also price move up in view of our expectation of budgetary allocations that will hit the system today. Much further on in the week, we'll also see some T-bills and MGN bonds maturing, which generally we're expecting significant liquidity in the system this week.
Let's look at some of the key factors to watch this week. We've got the MPC rate decision, as I alluded to, massive injection of liquidity that we're expecting into the interbank market as well this week, about 1 trillion naira in all. This is a very big number that we're expecting. And also maturing bonds coming through of 245 billion naira. Quite a bit of activity that is going to filter through, Tola. What is your view in terms of how this is going to affect bond yields and how it's going to affect the market going forward?
Naturally, this week, definitely bond yields will decline slightly. And we're already seeing that today. Prices moved up a bit, obviously, as people readjust their portfolios for the budgetary allocation that will hit the system today. On Wednesday, by midweek, we'll see about 245 billion naira worth of SGN bonds mature and T-bills equally. So naturally, you'll see a lot of decline in bond yields. However, we would expect the monetary authorities to deploy some monetary tools, for example, the open market operation in mopping up this seemingly excess liquidity from the system. Now, looking at the MPC meeting, we've also always heard a strong view that the benchmark rate should be reduced downwards. And of course, our argument is based on the need for us to have a general low interest rate regime in the economy to stimulate production and employment, thereby easing demand and the pressure on the domestic currency, and of course, easing price levels, because we think these are the key things that we need to employ to deflate the economy. And of course, once you have a cheaper cost of capital within the economy, you're able to produce more, you ease the pressure on the domestic currency, and then you create employment.
Okay, so Tola, if I could also just touch on the appetite for bonds at this point. We keep talking about it. In fact, it has been one of the key themes that CNBC Africa has been focusing on, the fact that most investors are very interested in bonds because of the high yield relative to equities. We saw the equity market recovering somewhat in the month of April and early May, and then faltering as the month went ahead. What kind of trend are you expecting to see when it comes to investors wanting to buy up bonds relative to equities, or do you see it both asset classes playing a very important role within portfolios?
Well, coming from the equity side, we hinge our arguments for a positive end of the year for the equity market on 3 key factors: the coming on stream of the market-making initiative, the ability for the boss to list more large companies, thereby increasing liquidity in the system, and of course, the amendments of the pension fund guidelines. If these 3 things come through in the course of the year, we might see the boss finishing the positive at the end of the year. However, coming back to the impact in terms of the activities in the fixed income market on the equity market, if the NPC, for example, decides to hold the benchmark rate at 12% or even move it higher, we might not see this come through well enough, because the argument is that since most of the investments we've seen in the domestic bond market and equity market is given by offshore investors, the argument would be that why would you leave risk-free assets of the federal government and selling for equities, which have the varying degrees of risk. So you continue to see that interest in the fixed income market, especially at the shorter end of the yield curve in treasury bills. I mean, you need to bear in mind here that Nigeria remains a BB minus country and below investment grade.
Tola,
so whoever is going to come into the country.
Absolutely. If I could just touch on the corporate bonds as well, the market has been very quiet. We've had one corporate bond issued and this year, and it seems that now the market has quietened down quite a bit. Are you expecting more corporate bonds going forward?
Well, if this interest rate regime continues, we are at least neutral. And obviously, we've been saying this for the last 18 months or thereabouts. The domestic corporate bond market has literally been wound down on the back of the interest rate regime, which you can see from the fact that only one corporate issue has come to the market this year. And the argument is simple. Why would anybody want to? I mean, if you look at the indicative yields on domestic corporates this year, we're looking at a band of about 17 to 18% to 19% on the high side. For the sub-national bonds, we have a band of between 16 to 18%. And now much of that is derived from the fact that the federal government itself is borrowing somewhere in the excess of 12%. So naturally, domestic corporate issues, especially the large ones, would easily go back to the bank loans that they had before, which you actually have easier access to these days for the large corporate studies. But the key issue is that now that we need to stimulate that small and medium enterprise sector of the economy that will generate employment, create production, and be able to deflate the economy, thereby reducing the pressure on the domestic currency and taking its toll also on price levels accordingly.
Fantastic, Tola. Thank you so much, sir, for your time.